Investors have been focusing on a wave of Q4 tech earnings as AI disruption fears sparked a rush out of the software stocks and a rotation out of some high profile tech names. Our research director Shiraz Mian is here now to put this and more in perspective for us. Shiraz, first of all, why has the momentum on tech stocks soured a little bit since we spoke last? It seems to have come back a little bit, but still sour nonetheless. The rotation continues. There seems to be a divide among tech stocks. Some are doing okay, some aren't. Is that a function of their earnings?
So, Terry, earnings for the group are still very strong, and the same in the aggregate as the outlook for the group. There's a number of factors, some indirectly tied to earnings that have been at play in the divide that you referenced here. On top, I would mention the capex budgets for the mega cap tech players, the Magnificent Sevens. Uh, we had become accustomed to these companies spending a ton of money in building out this AI infrastructure uh, for quite some time now. But even with those fairly well formed expectations, these companies were able to surprise us uh, with how much more they plan to spend this year. So, whether it's Alphabet, Amazon, Meta, uh, uh, there is this feeling uh, that the capex budgets from these players are out of control. Many in the market had come around to the view that capex spending peaks in 2026, but these new spending budgets has made many revise those expectations that perhaps the ramp up will continue into 2027 as well. So that's one key factor. The second is uh, what you reference at the top, Terry, the software group, and software, as you know, is a very big industry within the broader tech sector, and there is this fear in the market that the coming artificial intelligence driven world um, will be bad for the legacy software business, that artificial intelligence will disintermediate the businesses and uh, they'll still be profitable, they'll still be growing, but not as much as many had expected. So those are kind of like the big picture issues in the tech sector and the tech stocks. But on the Q4 earnings front, the numbers have been impressive.
So, earnings wise, tech sector, you say, still looks pretty good at this point. There's still earnings growth there.
Absolutely, very strong growth. As you know, tech has been the primary or most important growth driver for the S&P 500 index as a whole. In the post-COVID world, there was a period of 4 to 6 quarters when the sector struggled, but since the middle of 2023, it has been in the forefront. That continues in Q4, and by all measures, appears to be the case for the coming quarters as well.
And the Mag 7 earnings specifically, that picture looks okay too.
Absolutely. So six of the Max 7s have reported already. We had those issues that we referenced earlier. NVIDIA results are coming, but for on the whole, Q4 earnings for the group are on track to be up 24.2%. Revenues are expected to be up 18.9%. So still, when you contextualize these growth numbers in the context of how big these companies are, it's still amazing that they can achieve this type of top and bottom line growth in this day and age.
So, overall, aside from tech, I've seen stocks fall in trading even after reporting good earnings. Apparently, good earnings aren't enough this time around. Is it more the company's sales outlooks that are making a bigger difference?
Absolutely. It's all about outlook, Terry. It's about guidance. It's about how they see business conditions for the current and coming quarters unfolding. Uh, I would say the in terms of the pecking order of priority, if a company misses estimates for Q4 and paints a reassuring positive picture for the current and coming quarters, I would expect that stock to do better compared to a company that does very well for the Q4 results, but has underwhelming guidance. So it's the guidance that trumps the Q4 results here.
All right, so add all of what we've talked about now to the overall earnings pictures, and what does your scorecard look like?
So, including all of the results that came out this morning, Terry, we now have uh, results from Q4 results from 358 S&P 500 companies. That's 76.2% of the index. Market cap, 71.6% of the index's membership. Earnings are up 13% for these companies. Revenues are up 8.9%. 75.7% are beating uh, EPS estimates, and 72.1% are beating revenue estimates. There is clear momentum on the revenue side, both in terms of growth rates as well as the beats percentage. The earnings picture is a little mixed. The growth is about in line with what we have seen from these companies in other recent quarters. The beats percentage is a hair below the average for these companies. But all in all, a pretty strong earnings picture.
So, which are the sectors that are reporting the best earnings growth?
So, of the big ones, we mentioned tech. Tech remains uh, in very strong shape. The tech companies that have reported are showing 17.5% earnings growth. Finance had very good earnings results up front, about 20%. After relatively less prominent that gets spotlighted, I would feature energy. Energy numbers have been better than expected. Uh, after a number of quarters, the sector is on track, or actually produced positive earnings growth. Automobile, while negative, while earnings for Q4 are down from the same quarter last year, are less down. So better than expected for automobiles too. And as you know, automobile sector is kind of a unique ZAC sector. It has been struggling for the last 4 to 6 quarters. This quarter, Q4, is expected to be the bottom for the group and is expected to resume positive earnings growth going forward.
Retail sales for December came in flat. Do you expect this to show retailer earnings on a slower growth path in Q4?
So it's been a cloudier picture on the broader economic front, Terry. But on the whole, as far as earnings are concerned, I think retail earnings should broadly be okay. Not great, but not bad either. There's obviously a lot of dispersion between the strong performers and the underperformers. Um, People think of household financials as just one big group, but there is uh, a lot of variations. We have consistently heard from a variety of businesses, from the finance players to consumer-facing operators and restaurant players, that the overall household financials are in good shape. So I would expect that to get reflected in retail sector earnings in the coming days as well.
What do you expect the Q4 results to say about the overall economy then?
So that's been the big question mark. As you know, economic data has been uh, uh, less clear for the most part because of how the flow of data was disrupted by the federal government shutdown. I think what we are seeing from the earnings results and what these management teams are painting in terms of the macro outlook, the economy seems to be doing fine. There's been this ongoing worry around affordability and cumulative inflationary pressures that have been with us for a while, that have eroded the purchasing power of a key segment of consumers. But outside of that, consumers have been spending, demand trends have been stable to positive, and I would expect that overall narrative to be affirmed by the results from the retail group as well in the coming days.
Looking ahead a little bit, what's happening with the Q1 2026 and full year 2026 estimates?
I think that's one of the most important and less understood positive that has come out of the Q4 earnings results. There has been over the last couple of quarters a fairly notable development of less negative estimate revisions, with some sectors enjoying fairly significant positive estimate revisions. We are seeing that trend become more significant, both with estimates for Q1 as well as with estimates for full year 2026. If you ask me, I would say the revisions trend is a key positive, and is a big source of support for what the market has been doing lately.
Okay, want to remind everybody listening that they can take a look at your written commentaries on earnings trends and issues and analysis, and they can access that every day, actually, right on our homepage at Zacks.com. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.